Stop everything, right now. What you're about to see isn't theory. It's not prediction. It's cold mathematics that proves JPMorgan Chase is trapped in a position so catastrophic that when it collapses, the price doesn't rise. It detonates, and the fuse is already lit. 4.2 billion ounces short. That's the estimated exposure. Not rumor. Not conspiracy. Analyst calculations built from OCC derivatives data and CFTC trader commitment reports. 4.2 billion ounces. Global mines produce 800 million annually. JPMorgan is short more than 5 full years of every ounce dug out of the ground anywhere on Earth. And here's where your stomach should drop. Registered Comex inventory available for delivery right now, 123 million ounces. Their short position is 34 times larger than the entire pool of metal that can actually be handed over. This isn't a mismatch. This is a mathematical impossibility that ends one way. Either JPMorgan breaks or the price breaks. And I'm going to show you, using 1980 precedent, current supply mechanics, and forced liquidation modeling, exactly what happens when 4.2 billion ounces tries to cover into a market that has 123 million available. The answer is 347, and it unfolds in 21 days. Let me show you how this trap closes. Before we go further, absolute clarity. This is not leaked intelligence. I don't have insider documents. What I have is public OCC quarterly reports, CFTC commitment data, Comex warehouse statistics published every day, and decades of position tracking from analysts like Ted Butler and David Jensen. What you're about to see is scenario mathematics. If these conditions hold, if JPMorgan is forced to cover under current market structure, then here is what the data and historical analogs say happens. Could the position estimate be wrong? Yes. Could it be half this size? Sure. But even at 2 billion ounces, the outcome doesn't change. The math is so broken that cutting it in half still ends in catastrophe. Now let me show you the data. The OCC's quarterly bank derivatives report, Q3 2025, shows U.S. commercial banks holding over $1 trillion in precious metals, derivatives notional value. JPMorgan Chase holds the largest position. The report doesn't break down gold versus silver. It doesn't specify long versus short. But we can triangulate. The CFTC Weekly Commitment of Traders report shows commercials, banks, and mining companies net short approximately 350 million ounces in Comex futures alone. That's just exchange-traded futures. It excludes over-the-counter derivatives, options, and London positions. Independent analysts tracking JPMorgan's delivery patterns, vault movements, and cross-market footprints estimate total silver short exposure across all instruments at roughly 4.2 billion ounces. Is that number exact? No. Could it be off 20 or 30%? Absolutely. But even at half that size, what I'm about to show you still happens. The structure is so extreme that precision doesn't matter. Why would JPMorgan be short 4.2 billion ounces? This isn't a reckless bet. This is decades of accumulated exposure through market making, mining company forward hedges, industrial client risk transfers, and strategic positioning. When you facilitate silver trades for 20 or 30 years, when you hedge mining production, when you provide price protection to manufacturers, the positions compound. None of it illegal. None of it malicious. Just standard banking activity that in 2026, with silver at 90.56, up 195% in a year, has turned into a $128 billion unrealized loss. If their average entry was $60 per ounce, and that's conservative given years of accumulation at $20, $30, $40, then at 90.56 they're losing $30.56 per ounce. Multiply that across 4.2 billion ounces, $128 billion in the red. That's half of JPMorgan's $252 billion Tier 1 capital base. That's not a trading loss. That's existential damage. Accounting rules let banks carry derivative losses in ways that don't immediately crater regulatory capital. But there's a ceiling. Silver hits $100, losses reach $168 billion. At $120, $248 billion. At some point, regulators step in and issue the order: de-risk or we take control. And de-risking means covering. Covering means buying. And buying 4.2 billion ounces into a market with 123 million available means the price goes vertical. This is the trapdoor JPMorgan is standing on. And the mechanism that springs it, the force that makes covering unavoidable, comes from three simultaneous crises converging right now. Crisis 1. Comex delivery failure. March 2026. Contract open interest represents 507 million ounces. Normally, 5 to 10% stands for delivery. But these aren't normal times. Shanghai premium is $15. China locked export restrictions January 1st. Industrial buyers are panicking. If 20% stands for delivery, that's 101 million ounces demanded against a 123 million registered. Tight, but manageable. If 30% stands, 152 million demanded. If 40% stands, like we saw in January, 203 million ounces. The Comex cannot deliver. They face a choice: declare force majeure and cash settle, or source silver at any price. If they declare force majeure, confidence in paper silver collapses instantly. Physical premiums explode. Shanghai premium, currently $15, goes to $30, $40, $50. Paper might settle at $90, but physical trades at $140. JPMorgan holds paper shorts, but the real price is physical. They can't close shorts at $90 if actual metal costs $140. They're forced into the physical market as a buyer of hundreds of millions of ounces. And when they enter that market, supply doesn't exist. Price goes vertical. Crisis 2. Regulatory capital call. The OCC and Federal Reserve monitor derivative exposures against capital thresholds. When losses breach certain levels, they don't ask, they order. Silver hits $100, JPMorgan's losses reach $168 billion. At $120, $248 billion, approaching total capital. Regulators will not permit a systemically important bank to sit on losses that large. The directive comes down: reduce silver exposure immediately or raise $50 billion in emergency capital. Raising $50 billion on short notice to fund a losing position? Nearly impossible. No investor funds a sinking ship. So JPMorgan has one option: cover. But here's the killing blow. When regulators issue that directive, the market figures it out. Competitors see JPMorgan buying. Hedge funds smell blood. They front-run the covering. They buy ahead of JPMorgan, driving prices higher, forcing JPMorgan to pay even more. The regulatory order to reduce risk creates a feedback loop that increases risk. That's the cascade. Crisis 3. The China problem. China's silver export restrictions took effect January 1, 2026. Shanghai silver is trading at $96 while Comex is at $90. That's a $6 premium that should vanish through arbitrage, buy Comex, ship to Shanghai, pocket the spread. But the premium persists because China locked the valve. Silver enters. Silver doesn't leave. And that premium is widening. December it was $3. Now it's $6. By February, it could be $10, $15, $20. Every dollar it grows, arbitrage traders drain Comex vaults. They buy at $90, ship to Shanghai, sell at $106. Comex inventories bleed, and if China is accumulating, evidence suggests they are, then China is competing with JPMorgan for the same finite supply. Two massive buyers, one scarce market. China has infinite time. JPMorgan has regulatory deadlines, delivery obligations, margin calls. China waits. JPMorgan pays. China wins. 3 crises. Each one alone is survivable. All 3 at once is checkmate. Comex delivery failure plus regulatory capital pressure plus China accumulation equals total system failure. And the evidence says all 3 are happening simultaneously right now. This is no longer theoretical. Let me show you what happens when JPMorgan is forced to cover 4.2 billion ounces in 21 days. Why 21 days? because that's the window between March 1st notice day, February 26th, and March delivery close, March 31st. If JP Morgan realizes in late February that March delivery is failing, that regulatory pressure is mounting, that the China premium is exploding, they have until end of March to close positions before the situation becomes unmanageable. 21 trading days. Let me show you what happens. Before I walk the timeline, you need to understand why this is mathematically valid. The Hunt Brothers silver squeeze of 1980 is the closest historical analog. In 1979, the Hunts accumulated approximately 200 million ounces. Global production was 300 million annually. They controlled 2/3 of 1 year's supply. Silver went from $6 in early 1979 to $50 by January 1980, an 800% gain in 12 months. Now scale that to today. JP Morgan is short 4.2 billion ounces. Annual production is 800 million. They're short 5.25 years of supply. The Hunts were long 0.67 years. JP Morgan's position is nearly 8 times larger relative to supply than the Hunts. If the Hunts 2/3 of 1 year drove silver up 800%, what does 5.25 years of forced demand do? Scale linearly, 8 times the position size creates 8 times the impact. 800% times 8 is 6,400%. Starting from $90, that would be $5,850. Obviously absurd. Silver's not going to $6,000. But if the impact scales at even 1/10 the Hunt rate due to better infrastructure, that's still 640%, or $90 to $670. The scenario I'm modeling, 347, is a 385% gain. About 60% of the Hunt brothers' impact scaled for position size. That's not radical, that's conservative. And it happens in 21 days if the covering is forced. Day 1, February 26th, first notice day for March silver. Longs declare intent to stand for delivery, normally 5 to 10%. But Shanghai premium is $8. China restrictions are active. Industrial buyers are desperate. 25% stands for delivery. That's 127 million ounces demanded. Registered inventory is 123 million. They're short 4 million ounces. Silver gaps from $90 to $94 in the first hour. Comex issues an emergency statement, evaluating supply options, contacting eligible holders for conversions. The statement does nothing. Silver closes day 1 at $96. JP Morgan starts buying. Day 1 purchases 50 million ounces across futures, options, OTC. Normal daily volume is 8 million. They just bought 6 times normal. Price impact is muted because it's spread across venues, but it's there. Close, $96. Day 2, February 27th. Comex announces 20 million ounces converted from eligible to registered. Inventory now 143 million. March is covered. Silver dips to $94 on the news. But by midday, traders realize May and July contracts have massive open interest too. If March saw 25% stand for delivery, May and July will see 30% or more. Comex just burned their buffer for March. Nothing left for May. Silver rebounds, closes at $99. JP Morgan continues buying. Day 2 purchases, 60 million ounces. Volume is 10 times normal. Hedge funds see the pattern. They front-run JP Morgan. Buying knowing more, buying is coming. Close, $99. Day 3, February 28th. Shanghai premium explodes. Shanghai opens at $112. Comex is $99. Premium is now $13. Arbitrage traders flood Comex, buying every contract to ship and sell in Shanghai. Comex sees 8 million ounces withdrawn in 1 day. Registered drops from 143 to 135 million. March deliveries haven't even started and inventory is already bleeding. Silver opens at $102. By midday, $108. Technical traders, algos, retail FOMO, everyone piles in. Silver closes day 3 at 115. JP Morgan is in panic mode. At 115, they're down $75 billion, and they've only closed 110 million of their 4.2 billion. They have 4.09 billion left. Day 3 purchases, 75 million ounces. The buying is accelerating. Close, 115s. Day 4, March 1st. Financial media catches on. Bloomberg headline, Silver surges to 15-year high on supply fears. CNBC brings on analysts explaining Comex inventory crisis. Retail investors who've watched silver rise for 3 days start buying. SLV sees $1 billion inflows in a single day. 8.7 million ounces the ETF must source. Physical premiums explode. American Eagles jump from 30% premium to 50%. Dealers can't source product. Silver opens at 108 TD. Media coverage triggers institutional money managers who ignored silver suddenly wanting exposure. They allocate funds, buy futures, buy miners, buy physical. Silver closes day 4 at 129s. JPMorgan continues covering. Day 4 purchases 80 million ounces. But here's the problem. They're buying faster, but price is rising faster than they can cover. They're running just to stay in place. At 129s, losses are $97 billion. Close, 129 Days 5 through 7, March 2nd through 4th. These 3 days blur into relentless momentum. Every dip gets bought. Technical levels hold. Silver breaks 130, then 140, then 150. By close of day 7, March 4th, silver is at $160. JPMorgan has closed another 250 million ounces over these 3 days. They still have 3.84 billion short. Losses at $162 are $432 billion, more than their total capital. The bank is technically insolvent on the silver position. Regulators call emergency meeting. JPMorgan's CEO, CFO, Chief Risk Officer are summoned to OCC offices in Washington. The directive is clear. You have 14 days to close the silver position or we seize control. This is not a request. This is an order. JPMorgan has no choice. Close. 162. Days 8 through 14, March 5th through 11th. This is the final push. JPMorgan buys everything. Futures, options, physical, OTC, every instrument in every venue. They're buying 150 million ounces per day. The market can't absorb it. Liquidity dries up. Bid-ask spreads widen to $5, $10, 15 years. Silver becomes impossible to trade. Small orders fill. Large orders move the market 10%. Volatility is insane. Day 8, 174s. Day 9, 189s. Day 10, 207. Day 11, 231s. Day 12, 258. Day 13, 287. Day 14, 319. By day 14, March 11th, JPMorgan has closed 2.1 billion ounces. They have 2.1 billion left, but the capital destruction is catastrophic. At $319 and an average entry of $60, loss per ounce is $259. 2.1 billion ounces remaining times $259 equals $544 billion in remaining mark-to-market loss. Already closed positions cost $210 billion. Total, $754 billion. JPMorgan's market cap is $420 billion. They're beyond insolvent. Only emergency Fed credit lines keep them afloat. Close, $319. Days 15 through 21, March 12th through 18th. The final week. JPMorgan continues buying, but now something breaks. Comex changes the rules. They raise margin requirements to $70,000 per contract, double previous levels. They implement position limits. No entity can hold more than 5,000 contracts. These rule changes are designed to slow JPMorgan's buying. They backfire. Rule changes signal the exchange is panicking. Confidence collapses. Physical premiums, which were 40% over paper, go to 70%. The market bifurcates. Paper silver on Comex trades at $290. Physical silver in Shanghai and Zurich trades at $400. JPMorgan is forced to buy physical at $400 to close positions created at $60. Days 15 through 21 are a grind. JPMorgan closes the remaining 2.1 billion ounces, not all through purchases, some through negotiations. They call counterparties. We'll pay 150% of market if you take cash settlement instead of demanding physical. Some agree, some don't. By day 21, March 18th, JPMorgan has closed or cash settled the entire 4.2 billion ounce short. The price on day 21, $347 for paper Comex silver, $470 for physical. Average cost to close was approximately $190. Total loss, $546 billion. JPMorgan survives but is crippled. They required a $200 billion emergency Fed loan to avoid bankruptcy. The loan is announced. JPMorgan stock crashes 40% in one day. The entire financial system shudders. But silver is at $347. That timeline was not prediction. That was mathematical simulation of what happens if JPMorgan is forced to cover 4.2 billion ounces in 21 days. The specific prices on specific days are illustrative, based on modeling price elasticity, historical volatility, supply constraints. Could actual prices be higher? Yes. Lower? Possibly. Timeline 30 days instead of 21? Sure. But the directional outcome is robust. If JPMorgan is short 4.2 billion ounces and forced to cover under distressed conditions, the price goes to $300 or above. That's what the math says. That's what 1980 precedent suggests. That's what supply-demand fundamentals confirm. Let me show you why the supply constraint is real and why $347 is achievable. Global silver supply in 2026, approximately 1 billion ounces, 800 million from mining, 200 million from recycling. Global demand, 1.16 to 1.24 billion ounces. That's a deficit of 160 to 240 million ounces annually. This deficit has persisted 6 consecutive years. Inventories have been drawn down. Above-ground stocks are declining. In a normal market, a 200 million ounce deficit is manageable. Prices rise modestly, demand falls slightly, supply increases slightly, market rebalances. But what happens when you add 4.2 billion ounces of forced buying to a market already short 200 million? You add demand equal to 5.25 years of production to a market running a deficit. The result isn't modest price rise, it's vertical detonation. Because the silver doesn't exist. Miners can't produce it fast enough. Recyclers can't deliver it. The only way to satisfy demand is price rationing. You raise price until enough existing holders sell. At what price do private holders sell? At what price do ETFs see redemptions? At what price do industrial companies liquidate working inventories? Based on surveys and historical behavior, meaningful supply becomes available above $200. Below $200, holders hold. They believe prices go higher. Above $200, some sell. At $300, more sell. At $400, even diamond hands sell. The price must rise to the level that clears supply equal to demand. If JPMorgan needs 4.2 billion ounces and the market has a 200 million deficit, price must rise to induce 4.4 billion ounces of selling. That's approximately 5.5 years of current annual supply. To induce that much selling, prices need to reach levels representing life-changing wealth for holders. $300 to $500 is the range where that supply becomes available. $347 is the median estimate. Now the physical versus paper divergence, this is critical. In the scenario, by day 14, paper Comex silver trades at $319, but physical in Shanghai trades at $400. How can the same commodity trade at two prices? The answer is counterparty risk and delivery risk. Paper silver is a promise to deliver. Physical silver is metal in your hand. In a functioning market, those are equivalent. The promise is as good as the metal because you can convert promise to metal by taking delivery. But when delivery becomes uncertain, when Comex inventories near zero, when you're not sure the exchange can actually deliver if you stand, the promise is worth less than the metal. The discount on the promise is counterparty risk. Right now, today, that discount is small. Comex paper trades at $90. Shanghai physical trades at $96, $6 discount on paper, or equivalently $6 premium on physical, 7% divergence. In the scenario, by day 14, divergence is 25%. Paper $290, physical $400. Why? Because by day 14, everyone knows Comex is hanging by a thread. Everyone knows May and July delivery are impossible. Paper contract trades as cash settled. Physical market trades as the real price. If you own physical, you don't sell at $290. You sell at $400 because that's what metal is worth to someone who needs to possess it. And JP Morgan needs to possess it. So JP Morgan pays $400. Paper is the price of a promise. Physical is the price of reality. When reality diverges from promises, reality wins. Now let me address what JP Morgan will do to prevent this scenario. They're not sitting passively. They're going to fight using every tool available. Let me show you 5 strategies they'll deploy and why each one fails. Strategy 1. Negotiate with longs to not stand for delivery. JP Morgan's traders contact every large long they can identify. Don't stand for delivery, close your position, we'll pay 5% premium. Some agree. Smart longs don't. Because if JP Morgan is offering 5% premium not to take delivery, delivery is worth more than 5%. Smart longs demand delivery. Strategy fails. Strategy 2. Buy physical silver from dealers and miners before squeeze starts. JP Morgan tries sourcing 100 or 200 million ounces quietly through off-exchange purchases. They offer miners premium prices for forward deliveries. They buy from sovereign mints, from dealers. But the problem is scale. They need billions. The physical market provides tens of millions. Not enough. Strategy fails. Strategy 3. Lobby Comex to change rules. JP Morgan's lawyers pressure CME Group to implement position limits, margin hikes, trading halts. They argue the silver market is disorderly and needs intervention. Comex does implement margin hikes and position limits. But these rule changes don't stop the squeeze. They make it more violent. Strategy fails. Strategy 4. Get Federal Reserve liquidity support. JP Morgan requests emergency loans from the Fed to meet margin calls. Fed agrees, lends tens of billions. But the problem isn't cash. JP Morgan has cash. The problem is silver. You can't deliver cash against a silver contract. Fed can print dollars. They can't print silver. Strategy fails. Strategy 5. Media campaign to shake out longs. JP Morgan coordinates with financial media to publish bearish articles. Silver is overbought, correction imminent, take profits now. Goal is scaring retail longs into selling. Some retail sells. Institutional longs and physical holders don't. They see through it. They hold tighter. Strategy fails. All 5 strategies fail because the core problem is mathematical. 4.2 billion ounces demanded. 123 million available. No strategy solves that equation except buying at prices that clear the market. And the clearing price, based on supply elasticity, is $347. Now let me show you what this means for you. If you're holding physical silver right now, you're holding the asset JP Morgan needs to avoid insolvency. Let that sink in. JP Morgan, one of the largest banks in the world, $4 trillion in assets, needs your silver. They need the bars in your safe. They need your Eagles, your Maples, your Britannias. And if this scenario unfolds, they pay $347 per ounce. Maybe you bought at $30, maybe $50, maybe $80. Doesn't matter. If JP Morgan is forced to cover, your cost basis is irrelevant. What matters is you're holding supply in a market with a 4.2 billion ounce demand hole. That gives you pricing power. So what do? First, don't panic sell when volatility hits. The scenario has massive volatility. Day-to-day swings of $10, $20, $30. Media will scream bubble, crash imminent. Brokers will call suggesting you take profits. Ignore them. If the scenario is real, volatility is part of the covering process. It's not a top, it's the middle.